Pues podéis empezar cuando queréis, ¿eh? Ya está todo el mundo dentro, que estaban en sala de espera.
Okay, thank you, all of you, and welcome to this event that we are going to speak about integrating the United Nations Sustainable Development Goals in investments. First of all, I want to make you know that we are recording this event. And it's my pleasure to introduce our speakers today. We have Claudia Orbananos, Vice President of the EMEA sales team at BlackRock. Welcome, Claudia. And we have with us also Yves Ronley, member of the BlackRock Sustainable Team. Welcome, Yves. Claudia and Yves are going to run a conversation, and we will have the time at the end to make questions. You can write them in the chat or send them directly to me. Claudia, Yves, we can start when you can.
Gracias, Cristina. Buenas tardes, boa tarde. Welcome and thank you everyone for joining us this afternoon. Before we kick off, on behalf of BlackRock, we want to thank the CFA Institute for inviting us to participate in discussions focused on sustainability. Climate risk will fundamentally reshape finance and drive a significant reallocation of capital. The net zero transition will create risks, but also a historic investment opportunity. We believe a successful and orderly net zero transition is in the financial interest of both our clients and the economy. As this transition unfolds, the necessity of adopting a fair and equitable pathway is stronger than ever. As a framework of global, social, and environmental objectives, the United Nations SDGs demonstrate the interconnection between financial and sustainable performance. In the next hour, we will discuss how the UN SDGs can be material to investments and address the challenges and opportunities for investors looking to integrate them into investment decisions. So if taking 2 steps back, what the UN SDGs are and why it is important for the world to achieve them.
Thanks, Claudia, and thank you very much for having us tonight, and good evening, everyone. So I agree, it's a good idea to take us back to basics. So what are the UN Sustainable Development Goals? So the UN Sustainable Development Goals were adopted back in 2015 by all the UN member states as part of the 2030 Agenda for Sustainable Development. They consist of 17 goals that cover a wide range of topics and issues that the world must collectively achieve by 2030 to end poverty, protect the planet, and improve the lives and prospects of everyone everywhere. Now, in order to track progress to these 17 high-level overarching goals, the goals are further detailed across a set of 169 more actionable targets that were then measured by 242 performance indicators. And being able to track this progress is very important, as knowing which SDGs are furthest away from being achieved can ultimately help countries with setting their priorities. And it will also help investors who wish to deploy their money in a way that maximizes their sustainability outcomes, or in areas that may offer future investment growth opportunities. So Claudia, if we could move on to the next slide. It's really important to also consider the UN SDGs as a way to especially help us frame the costs of staying on our current course of human development, and this cost on our collective economic, social, and environmental prospects. And very much like climate change, the cost of inaction can be substantial. For example, the cost of biodiversity loss alone was estimated to have impaired up to a third of global GDP. That's between the period of 1997 and 2011, while over 50% of global GDP is expected to be tied to economic activities considered highly dependent on nature. But the flip side of that, of course, is that it also opens up a lot of new investment opportunities. According to the Business and Sustainable Development Commission, achieving the UN SDGs could open up some $12 trillion of market opportunities in areas including food and agriculture, cities, energy and materials, and health and well-being, which represent around 60% of the real economy. So when we think about why the SDGs are important and whose responsibility they are, we know that they carry universal importance for our collective global economic, social, and environmental well-being. And yes, countries are ultimately responsible for their delivery and for carrying out policy action to drive them and create the right incentives for the market. But it is in many cases that the private sector is actually uniquely and wholly able to drive those necessary changes to ensure the world is able to make those transformations happen.
So can you elaborate further on why does this matter to investors?
Absolutely. So, I mean, on top of the economic costs to the global society that we've looked at, we've also seen that since their launch in 2015, the UN SDGs have also gained universal appeal with regulators, industry bodies, and asset owners who are increasingly heightening their scrutiny over the impact companies have on the environment and on society. And this is particularly relevant today as the world is mobilizing towards the achievement of the Paris climate goals to limit global warming to well below 2 degrees. And we see that policymakers are beginning to realize that no transition will be possible without considering the social implications, as carbon pricing mechanisms and the physical consequences of climate change are already beginning to magnify those individual and regional inequalities. And the breadth of the UN SDGs really encompass so many of these dimensions. And as such, we can see the SDGs as really a signal for future regulatory pressures, companies' social license to operate, and as well as market and investment opportunities. And this really ultimately has the potential to even lead to a fundamental reallocation of capital towards the achievement of these goals. For example, we can see heightened scrutiny on investments is bound to put more pressure on asset managers and investors to really start assessing the sustainability outcomes and impacts of their investment. And the SDGs also appeal really well to individual investors as a framework for sustainable and even impact investing. So the SDGs also really have this power to potentially democratize access to sustainable finance through this very universal and actionable lens. And what this also means more at the company level, the companies that understand their impact on the environment and society, and therefore align their businesses with the SDGs, may have the potential to ultimately become market leaders against their peers and potentially benefit from this capital reallocation. And similarly, those that fail to adapt will more likely face more pressure from regulators and be open to the reputational repercussions of their inaction. So therefore, this holds a lot of relevance for investors, and it's important for investors to understand how the SDGs might shine a light on both future investment opportunities as well as risks that need to be managed effectively.
How can investors know whether their investments are supporting or detracting from the UN SDGs?
So this is the billion-dollar question, and it's a very complicated issue because there really is no guidebook. There's no consensus yet on the universal approach to measuring alignment to the goals. But this is why we believe that it is first very important to understand what constitutes company support of the UN SDGs. And apologies for my dogs. I think they're realizing dinner time is soon. But going back to this issue, so at BlackRock, this is one of the things that we've made a very proactive choice. We've chosen to draw a very clear differentiation between the terms alignment and impact, which are two terms you're going to hear very often in the context of the UN SDGs. And we really want to draw this line to separate the investments in companies that have a more general alignment to spirit and intention of the goals from those investments that actually contribute to the real world achievement of the goals. For example, you can think about real world impact as looking at how many units of affordable housing were generated to help revive rural communities, or how many students from underdeveloped areas gained access to higher education. Meanwhile, alignment might be more looking at a beverage company with good water management policy, And this distinction is what separates broader sustainability conscious investment strategies from those more dedicated impact investment strategies. Now, for most investors, they'll most likely focus on the understanding how their portfolio are positioned to align with the UN SDGs, as this is probably going to have more universal applicability across different investment strategies. And this is an area where we believe there are essentially three key challenges for investors. The first one is company relevance. This is as the SDGs were ultimately written by policymakers for countries and not by investors for corporate issuers. And as such, some SDG targets may have limited relevance for corporates or to certain sectors even. For example, alleviating global poverty or promoting peaceful society or rule of law are more specifically directed at country level actions. Meanwhile, reducing carbon emissions and promoting labor rights have very broad applicability for companies very widely. The second challenge is having a complete picture of a company's alignment. And this means avoiding cherry picking SDGs that the company has only positive alignment on. So if we, for example, we can look at a company that provides technology solutions that promote global connectivity and access to technology, which might mean that it then has positive alignment to SDG 9 under industry, innovation, and infrastructure through its provision of its products and its services. However, it's also important to consider alignment to other SDGs and looking not only at the positives, finding those negative externalities, and looking beyond just the products and services that a company puts out, but also any alignment arising from the company's operations. So going back to that same company, perhaps also looking at the company's environmental footprint or its provision of equal opportunities for its employees could provide a more holistic picture. And the third challenge is prioritization and prioritizing the SDGs that are most relevant for a given company and where a company might have the most direct links. And this is where things get quite complicated sometimes. Because going back to the first point, not all SDGs will be relevant for all companies. But let's take an example of the objective to ensure the conservation of natural habitats and ecosystems, which might be especially relevant to companies in the agriculture sector, as they will have the most direct links to the delivery of this goal. So therefore, for investors, it would be especially important to understand if any of its constituent companies in this sector have negative alignment to say SDG 15 for life on land, because it will be those companies in that sector that will have arguably the most direct links and they'll have the most potential for that impact. So investors need to be mindful of these challenges really when looking at ways to measure and report their investment alignment to the SDGs. And today we are seeing a growing number of data sets that attempt to quantify the company's performance against the goals. And most of these methodologies tend to generally agree on assessing companies' revenue generating activities and linking those to the SDGs. But we are seeing generally less agreement on how and if companies' operations should be linked to the achievement of the goals. So at BlackRock, what we've done is we've surveyed existing frameworks and try to establish some guidelines for best practices on measuring UN SDG alignment that you can see on screen. And our best practice guidelines really require any UN SDG alignment framework to undertake a holistic assessment that looks through to the underlying 169 targets, not just the 17 goal level, to really identify those most relevant ESG indicators for each company and assessing contribution from both revenue generating activities as well as operations, and again capturing both the positive and the negative alignment stories. And to really put this into practice, most frameworks would measure alignment by taking public information on business involvement, exposures, performance, and controversies, and linking these to the specific targets underpinning each SDG. And this is a useful method for reporting absolute alignment at the portfolio level, and it's a good guide to those key exposures, and it can be applied to portfolios very broadly, whether they're SDG focused or not. However, what we also found in our survey was that really the most powerful and decision useful frameworks were also trying to help investors draw clearer differentiation between companies who are more exposed to future risks and opportunities, and as well factoring things like sector relevance and, most importantly, financial materiality aspects as well.
So from your last comments, Eve, focusing on exactly those terms, sector relevance and financial materiality, can you discuss BlackRock's research into how the UN SDGs might highlight issues that are material to financial performance? And here, feel free to add some concrete examples to cover this in more detail.
Absolutely. So this has been something that we've spent a lot of time on over the last couple of years, mostly last year as well. But we started our research essentially with the premise that as a framework of global social and environmental objectives, the UN SDGs could potentially shape our understanding of ESG factors that are materially, financially material to companies, and also tell us how these might evolve over time. So of course, investors with experience already in integrating ESG factors in their investment processes would understand that not all factors are equally material across portfolio holdings. And the same is very much true for the UN SDGs, as exposure to future regulatory pressures and market opportunities across different issues will also vary across different businesses with different exposures. So really understanding how the UN SDGs overlap with material ESG factors could ultimately enhance the way that we prioritize UN SDG related indicators in ESG integrated strategies. And indeed, our research has unveiled a very significant overlap between the SDGs and company indicators that are material to long-term financial performance. In our research, we based our analysis on a mapping between the SDG country indicators, so we went really granular, and the most widely accepted ESG corporate materiality framework developed by the Sustainable Accounting Standards Board, or SASB. And this mapping revealed a matching level of 70%, meaning that a vast majority of those SASB material indicators had a direct correspondence with the SDG indicators. But we can look more closely at how this match varies across the different layers. So if we move on to the next slide, first we can explore the level of correspondence across SASB's main categories, and you can see those on the graph there. And what we found was that SASB and the UN SDGs were actually very closely aligned on current issues that are relevant and material to the private sector. For example, we can see that the matching level is especially high in the environment, business model and innovation, and human capital categories, which are directly relevant to issues like climate change, responsible production and consumption, sustainable construction, and waste management goals, which are very heavily represented within the SDG framework. But on the other hand, we also saw that there were inherently categories which were more specific to company performance, things like data security, competitive behavior, and systemic risk management. And intuitively, those would not overlap quite so much with the SDGs. On the next slide, we also observed the materiality of the SDGs across the different sectors. So, for example, we can see that extractors and minerals, infrastructure, and food and beverage have a very high occurrence of those material ESG factors that overlap with the SDGs. And this is largely due to those sectors' high correspondence with material indicators under the environmental and business model and innovation categories that we looked at earlier. Meanwhile, sectors like services and financials have a lower match overall, but they did still have some of those matches with indicators covering issues like professional integrity and the monetary risk of climate change. And on the next slide, we also intuitively perhaps found that some SDGs have inherently a higher correspondence to material ESG factors and company indicators. Now, as we know, that this is very intuitive. The UN SDGs were designed for country goal setting, so it's really no surprise that not all targets will translate into actionable company contributions. And we can see that 5 of these SDGs account for the vast majority of the financially relevant ESG indicators. So we're looking at SDG 6 for clean water and sanitation, SDG 8 for decent work and economic growth, SDG 7 for affordable and clean energy, SDG 12 for responsible consumption and production, and SDG 13 for climate action. And these constitute 2/3 of all the SASB materiality matching indicators. And really identifying which SDGs are most relevant to companies' prospects can really help us highlight key areas of financial risks and opportunities. For example, management of water resources, energy consumption, and duty of care towards the workforce are all factors that are going to be not only material to long-term financial performance, but also will have the potential to really advance or detract from the world's progress on the SDGs. And on the next slide, finally, we also wanted to understand how those matching indicators split across 3 categories that we defined. These are positive contribution indicators, negative externality indicators, and indicators of risks the companies need to manage. And we categorize those across the entire SASB framework and then within those matching indicators. And what we found is that the majority of the ESG material indicators that map to the SDGs actually also pertain to company risk management and the minimization of negative externalities for the most part. That covers issues such as greenhouse gas emissions and resource use. And this really tells us 2 things. First, that the management of negative externalities today may be increasingly more material in the future as regulations and consumer preferences align with the goal achievement. And the second thing it tells us is that it reinforces the need for sustainable objectives that integrate the SDGs to measure all aspects of a company's output and operations, whether they are positive or negative. And just lastly, on the next slide, we also wanted to highlight another finding from our research, which touches upon one of the, again, big challenges of measuring SDG alignment, and that is data. What we found from our mapping that it revealed very prominent gaps in company disclosure data. For example, for SDGs 10, 9, and 4, we were not able to find any available company data to inform those relevant material SASB indicators, while SDGs 3, 6, and 7 are still experiencing very noticeable gaps. Now, part of this gap will close as regulators will likely introduce some new requirements for companies to improve their disclosures alongside their management of social environmental impacts. But we also believe that the direct engagement with companies can also be a very powerful tool for driving this change and helping close this data gap. So if I was to summarize the key takeaway from our research, I would say that our results show that integrating the UN SDGs can be relevant for investors to not only align their strategies with sustainable objectives, but also to incorporate those associated risks and opportunities into their broader ESG integration strategy.
So final question on my side, Eve, which I'm pretty sure the audience is thinking of, how has BlackRock approached integrating the UN SDGs in investments?
Absolutely. So not unlike many areas of sustainable investing, this is a relatively new space for investors. And we have worked with our clients to come up with different ways of integrating the UN SDGs across the investment process to fit the variety of financial and sustainable outcome objectives. But perhaps going back to the 2 terms I mentioned earlier that underpin our approach, those are alignment and impact. We broadly separate our SDG strategies under these 2 constructs. So starting with alignment first, perhaps. Alignment focuses, again, on how companies broadly align with the principles and objectives of the SDGs. And this assessment can be applied to most any company. However, it isn't very precise very often, and it doesn't target a measurable outcome in the real world. Now, we are seeing a growing number of providers for these assessments, though, from the likes of MSCI, Sustainalytics, Truecost, and a number of others. And these usually rely on very large systemic data sources that collect information from company reports and public sources. So they offer very large coverage and therefore quite well suited for index and systematic strategies. However, there are drawbacks to this approach, as we've seen many of these methodologies employ what can probably only be called very generous mappings of economic and business activities, or even entire sectors, to SDG targets, which often results in some overestimations of company alignment, and in some cases, a lot of double counting by double mapping economic activities to more than one goal. Now, there is also the option of conducting a more precise, fundamental review of companies' products and services and operations to produce deeper insights and more precise assessment of that company alignment. Now, this approach, of course, would be preferable due to its improved accuracy, but it does require a lot more research resources and can usually therefore only cover a small number of companies. So this is usually best suited for your more fundamental and stock picking strategies. And when it comes to how do we actually categorize these alignment strategies, we generally see them as taking two broad approaches, depending again on the investor's financial and sustainable objectives. The first approach is as a thematic investment that seeks to benefit from the potential growth opportunities that arise as the world moves towards achieving the SDGs, and going back to that, to this tectonic shift towards sustainability. And this usually is more focused on the company's revenue and revenue from its products and services that align to themes like sustainable strategy, circular economy, clean transport. And the second approach is as a sustainable objective that seeks to have more comprehensive alignment to the UN SDGs. So you usually consider the contribution companies make to the SDGs for the full value chain of their business operations and enables investors to capture company management of negative externalities. So for example, again, a company in the beverage sector could be providing products related to nourishment, but it will also have links to other SDGs through its agricultural practices, water use, and plastic waste. The second construct here is impact. Now, with impact, investors really seek to invest in the transition towards a more sustainable and equitable world. They can use the SDGs as a guidepost to those environmental and social objectives, and then use that to identify areas where their investments might make the most real-world impact. And this means that investors will have to look beyond companies' alignment and really identify those direct links between their investments and the consequent real-world impact. Now, this link between the investment and the real-world impact is really integral to the way that we define impact. And this requires investments to be three things, to be intentional, additional, and measurable. And the additionality component in particular is especially key. This means that it is not enough for a company to evidence it has provided healthcare for a great number of individuals. It also needs to show how it has done so in an area that was previously underserved and did not have access to healthcare before. So in essence, it has brought the world closer to closing the gap on the SDG targets. And therefore, impact investments are often market makers or innovators or disruptors in their fields. This also means that impact strategies are inherently reliant on much more holistic and detailed assessment of the company's contributions, and therefore, again, lends itself to more fundamental investment strategies, where investments in companies are very thoroughly researched and handpicked. And finally, reporting forms an essential part of both of these constructs. And it can be applied in addition to that to not only SDG focused strategies, but more broadly to sustainable strategies and even beyond that as an ex post check on portfolio alignment. And of course, what we can see is that the space of UN SDG investing is still evolving. And we have seen many different interpretations of what constitutes a UN SDG investment strategy. This is a space that will likely become increasingly scrutinized, though, given the global significance of the SDGs. So we do believe that transparency will be key. It is essential for asset managers to provide a clear visibility on the sustainability outcomes targeted by their SDG focused strategies in order to avoid coming across as rainbow washing. However, it is also a space that offers many opportunities for investors. And we do believe that investing in alignment with the SDGs has the potential to deliver value to all investors and will play a key role in accelerating the global transition towards the goals. So we strive to offer our clients a broad range of solutions coupled with greater transparency on their sustainable outcomes.
Really interesting event. Thanks for sharing so much detail and insights around the relevance of UN SDGs, the challenges, but most importantly, the opportunities for investors and, of course, BlackRock's approach. We'll leave it here. I'll pass it on back to you, Cristina, to address any potential questions. Thank you.
Okay, thank you very much, both. If I will start with the questions, and I remind all of you that you can write any question you have in the chat or send them directly to me. I'm going to make a first question. So if we hear a lot about climate, but there are other SDGs that offer opportunities for investors.
Yes, sorry. Can you just repeat the question? I think just the line broke a little bit.
Yes, sorry. Is that we hear a lot about climate, but there are other sustainable development goals that offer opportunities for investors.
Yes, absolutely. So climate, of course, is one of those global issues that has a very high priority on the corporate and political agenda. And this is why we also see a great number of mentions of climate relevant targets across a number of the SDGs, like affordable and clean energy and climate action for SDG 7 and 13. But of course, from our research, we also saw that these SDGs are also very relevant to a very broad range of sectors, which means that corporates are generally well placed to make significant contributions or detractions from these goals. But of course, as we looked at previously, there are other SDGs that also offer investors a very broad scope of opportunities, such as clean water and sanitation for SDG 6, decent work and economic growth for SDG 8, and responsible consumption and production for SDG 12. However, this doesn't mean that other SDGs are not important or that they cannot be acted upon by the private sector, only that investors might find more opportunities to align their investments with those 5 SDGs. And indeed, as we've seen very clearly in the last year, is that having a global lockdown was perhaps very good for climate change for a short period, but it really detracted from so many other important social aspects of our global well-being. So really, when it comes to achieving the goals, it needs to be a balance between achieving all the goals in a balance. But really, going back to the financial materiality piece, knowing really which company activities are relevant to the SDGs can really help investors who are looking for ways to also maximize their contributions. It also helps investors apply higher scrutiny over company reports that are perhaps less rigorous and maybe more prone to cherry picking. For example, we can take a corporation that might say that their philanthropic support or charity donations might make it more aligned with SDG 1 for no poverty, but this is arguably plays a more anecdotal role than actually helping solve the world's poverty struggles. And this is again why looking at financial materiality in the context of the SDGs can act as this goalpost of where investors can maximize their contributions to the SDGs and find those opportunities based on that assessment of the most relevant exposures and activities.
Okay, thank you. I've got another question, and this is more regarding something that you mentioned during the explanation regarding the information and the information that corporates disclose to investors. And it's true that we have improved, or corporates have improved a lot, the information they disclose in recent years. But what is the approach you take when the information is not available?
So there is, as I mentioned, there is a rising number of different methodologies and data vendors, especially in the last 12 to 24 months. We've seen more and more data vendors try and expand in this area. And what we've seen is that for a lot of them, they've mostly, at least at the start, tried to take a lot of their existing ESG kind of research resources and usually scoring, research and capital, and try and convert that into the SDG context. And we've seen that in places done well, and in some places less well, because it is essentially repurposing an existing framework and trying to fit it in. But we have also seen a really great effort from a few data vendors to try and build dedicated solutions into this, and actually directing more of their research kind of force and teams into really doing much more dedicated data collection for the issues that are specifically targeting the SDG goals. It's a very complicated issue because disclosures are still not fundamentally that good, but there's a couple of things that you can do. The first thing is, of course, it's referring to our approach with financial materiality. So you know exactly for which companies, which indicators are most important. So you don't necessarily have the same 200 indicators you pick up from each company. You perhaps know exactly which 30 or 40 or 50 you need to pick for each company based on what you understand to be most material, and where that company can have the most material consequence for that SDG as well. And that helps narrow down a little bit your research scope and data collection. And of course, where you are not able to get some of this information from public sources, you could always turn to the more fundamental driven research. And of course, that limits a little bit the amount of coverage that you can get. But of course, that is always best. And another thing that I would probably highlight as well is that we've noticed how important the granularity of a taxonomy is as well. And when I talk about taxonomy, it's what we refer to as the very detailed mapping of granular company activities to the SDGs. So, for example, if we take a pharmaceutical company, you can have in the taxonomy, the provision of pharmaceuticals and drugs as an aligned activity. But what we've seen some taxonomies do especially well is that they'll differentiate between over-the-counter and prescription drugs. And over-the-counter, they've made a judgment that we perhaps would agree with, that doesn't really advance the goals quite as much. It doesn't quite have the same consequence as prescription drugs, which we agreed actually makes more sense to be an aligned activity. You take that granularity of taxonomy to perhaps a different data vendor who just looks at revenue from selling drugs or from provision of healthcare services, and they map that directly to the SDG 3. So we do believe also there is, where possible, granularity should be is very preferable where that information is available. Otherwise, of course, if all you have is policy data or really high level revenue data, then that is, of course, still a valuable proxy, but then you just need to appreciate the degrees of confidence you can have in the quality of that data.
Thank you. We have a question from Guillermo asking from a fixed income perspective, how do you assess the SDGs alignment of your portfolio?
So our focus so far has been admittedly in the public equity space, where a lot of that data is still quite available. And in fixed income, in the same sense, for publicly listed companies, we would still take that same approach. We'll look at the company's broad alignment, and we'll treat those fixed income securities in a similar way as we would perhaps public equity. I suppose where you have the biggest distinction is where you have things like social bonds and green bonds, and some of your other kind of sustainable bonds. And in those cases, you would make the exception where you have sufficient evidence that that the investment is going specifically for the achievement of those specific green products or social projects and social projects. And something that we've also done at BlackRock is our fixed income team has developed a system for also judging the quality of green bonds. So they come up with different shades from dark green, light green, and everything in between of how green actually a bond is, which gives us a good indication of actually, how well safeguarded is the investment, and also how, beneficial is the project for which they are directed. And that also helps inform our assessment when we blend that into the UN SDG assessment as well.
Okay. Hope, Guillermo, this answer your question. We have another question from Nelly. European regulation has set up the so-called DNSH principle, do not significant harm, in order for the activity to be sustainable. It shouldn't harm any of the environmental social goals. In your case, there could be a company very much aligned with this, with one of these goals, for example, energy efficiency, but at the same time, acting adversely in relation to another, gender diversity, just an example, of the SDGs. What's your approach in those cases?
Yes, sorry, I'm not sure I quite got the full question. Let me see if I can answer it, and let me know if I'm still not quite getting it right. But we do believe that the UN SDGs actually can play a really useful role under the SFDR regulation for the DNSH tests. Indeed, we believe that the UN SDGs form a very useful referential for companies' sustainable environmental and social connections and contributions. So it is actually something that we have ourselves explored, including some measure of looking, referring to the UN SDGs, companies that have misalignment across the variety of all the SDGs, and really setting up some rules on companies that are misaligned to, one or more SDGs could arguably be seen as not passing the DNHS test. So it's something that we actually are also thinking about a lot, and it's something that we're exploring and incorporating in the way that we think about setting that do no significant harm test, and specifically focusing on those negative externalities that get captured by the SDGs, because as you mentioned, they capture so many useful indicators under environmental, under social, even under governance, that it's one of the really, really great kind of catch-all referentials. Sorry, did that answer the question? I'm not sure if I missed something.
I think that the question was focused on when you have some contradiction in what the company is doing with some SDGs versus on others. So can be very, environmental because of the particular business. That is the example that Nelly was putting, but also at the same time, acting against others that are at the same level, like could be, for example, a gender diversity or any other, perhaps more in the social space. And how do you approach in those cases?
Oh, absolutely. So it ultimately does come down to as well how you would view, going back to this point on prioritization. So would you prioritize certain SDGs that perhaps matter more to you as an investor? I think, in the sense of something as the DNHS, the Do No Significant Harm test, which is perhaps trying to capture more universally a variety of issues, the way that we've at least thought about it is that we wouldn't really discriminate between the SDGs. So if we look at a company that we want to think about a company with a sustainable investment objective, we will definitely hope that it is aligned to at least one SDG. But when we do our Do No Significant Harm test, we would expect that it doesn't misalign with any one other SDG. So even if it's aligned to climate, if it is actually misaligned on, clean water, if it's misaligned on, on gender equality and social aspects, we would consider that as breach of the Do No Significant Harm criteria. So it really is going back to having this holistic assessment and avoiding cherry picking just a positive story, having this balanced view. And if a company is doing really well because it's, it's doing something positive from its product side, if on the operation side it's doing something profoundly harmful, then it would not pass that criteria. And but again, it comes down to as well, in the context of a specific investment strategy, what the investor goals are and what the priorities are. We've also worked on some solutions where the investor was more interested in just the positive stories, and they wanted companies that had passed a certain revenue threshold on positive alignment, and they didn't really want to necessarily do the negative side, and that's fine. But when it comes to the way that we run our processes, we would always kind of err on the side of caution advise that you at least understand the holistic exposure, not the least because it will expose to you where you may have some risk exposures. So understanding if a company is not managing well its social aspects and has poor governance, this could tell you a lot about the company's future risk, reputational, regulatory, and legislative. So it is a balance, and ultimately it's a judgment call, but we would always kind of err on the side of caution and advise that holistic approach.
Thank you. We have more questions. How do you incorporate your SDG assessment into your engagement activities? Is your dialogue with companies structured around the SDGs?
Yes, absolutely. So that's a really good question. So our investment stewardship team has every year they come up with a list of their engagement priorities, and those cover a range of, again, environmental, social, and governance issues, and that will capture a lot of it will again be very closely tied to a lot of our kind of work internally on the way we've been looking at what are material ESG issues for companies, so they know what topics it is important to engage with companies. So perhaps, for example, one of the key areas that they're engaging with companies this year is natural capital, and urging companies to improve their disclosures in that space. So it's definitely a referential for our investment stewardship team to look at those material ESG indicators. And another thing that also our team has done that you can also find online is they have also mapped a lot of their engagements to the SDGs as well, so you can see which areas are covered. And there's plenty of examples of cases as well where our team has engaged with companies on issues around water, around natural resources and biodiversity, and climate. So it's definitely something that is well integrated into the process as well, and how we think about talking to clients and where we urge the improvement of disclosures that we've noticed, and to try and close some of those gaps.
We have more questions. Do you assess the alignment taking into account the weight of a bond or the duration it provides to the whole portfolio? This is related again to the fixed income question before.
So I'm hoping I'm understanding it correctly, and apologies if I'm not quite hitting the right mark and perhaps getting into technical. I'm hardly a fixed income specialist. I'm afraid that's not my area of expertise, but perhaps let me see if maybe this will answer your question. If maybe I perhaps talk about what the time horizon perhaps is for the relevance of the UN SDGs. Maybe that's going to be a helpful way to answer this. And it is a good question. Are the UN SDGs only something that we think about is something that matters only in the long term? But really, when we've been talking about materiality, what it is, we've really observed a mix between these long-term drivers, of things that will happen in the future, but also the impact of investor expectations in the journey to that point. For example, we know that the climate transition will not happen in the next 2 years, and we know that global inequality will not be solved in the next 5. But we are already seeing countries really mobilize their agenda around the goals. So, we're already trying to meet commitments as part of the Paris Agreement. And that is inevitably going to be moving a lot of capital in the direction of sustainable and climate solutions. And this will inevitably feed into investors' expectations today about the future value of companies. So this is why we're talking more and more about the future cash flows and valuation problems, like stranded assets in the context of fossil fuels, or the future cash flow projections of companies that are investing in the renewable energy side, and how we're talking about these kind of future projections of both gains and losses. And even though things like stranded assets, those are assets that are still functioning today, in the future we know the regulators might be imposing more requirements to get those phased out, and therefore nullifying their economic value. So really, we're already thinking about that, and that's something investors are already beginning to take notice of. And we therefore see the UN SDGs really playing a role across different timelines, from when some of these changes are going to take place in policy and consumer preferences, in the future to investors' expectations on the direction of growth and this tectonic shift towards sustainability. And for the long-term investor and the medium-term investor, we know that sustainability is only a small portion of investments still today. So we know it is a good time. We're still in those early days of the tectonic shift, so it is a good time to enter the space. But also for the short-term investors, you could observe also benefits to taking the SDGs into consideration today, as well as many of those regulatory and reputational risks that perhaps sit in the long term can also materialize into short-term volatility and controversies for those investee companies that perhaps have poor environmental and social track record that puts them in opposition to the SDGs. And this is why we ultimately believe the investors across all time horizons can benefit from considering those materiality aspects in the SDGs and really capturing both that risk perspective, that financial performance perspective, and sustainability perspective when making their investment decisions.
I'm not sure if, because the question is not mine, but I think the question was referring more to the reporting of that specific portfolio in fixed income. Which are the, how do you account if the weight of a bond in the portfolio or the contribution to the duration of that bond to the total portfolio? I think the question is more related, how do you calculate the alignment of that particular portfolio? I think the question is more related to the reporting, but Guillermo, perhaps you can give us a little bit.
Yeah, Guillermo, I think I've got a couple of your questions that are not quite right. Apologies, I apologize. Look, I'm hardly the fixed income expert. I'll defer to someone else here, but I think I understand the question, I think, a bit better, but probably how we would still at this stage consider it. I'm just thinking that in how we do some of our reporting on our fixed income products. And Claudia, please feel free to correct me if I'm wrong, but we still look at it more from an exposure perspective, from like a market value perspective, as opposed to a duration weighted exposure metric. So I suppose it will be something similar on the fixed income side as we would for equities, where we just take the market value weighted exposure to the SDGs. I hope that answers your question.
So market value is what you take.
Yeah, I would think so. Yeah.
Yes, because he is by weight is what he means, Guillermo.
Yeah, I suppose, and we can follow up on this with more detail.
But I appreciate the intuition. As a risk measure, you would weight it by duration because that's your exposure as a fixed income. But I suppose if you had a dedicated UN SDG risk metric, which is something you can absolutely develop, then that would make sense that you could then kind of weigh that with duration, because that is ultimately your risk exposure with fixed income. So I think I understand the intuition there, and it's a good one. I think just when we talk about, let's take MSCI's product alignment metric, for example, that looks at the revenue that the company is deriving from, let's say, provision of healthcare. So for that, you wouldn't really weigh it by duration. You would just take the market value exposure that you have to that company and take that.
Thank you. We have more questions. We have another one. How does BlackRock gather impact metrics? And in particular, if you are taking manual work, or do you rely on any provider or any real information? You can elaborate a little bit on that.
Yeah, definitely. And I'll do my best to kind of again answer this question. We definitely have a dedicated global impact team that do all of this really incredible work, and they're very, very kind of detail and research oriented team that come up with a very detailed and concrete framework around how we think about impact. But a way of thinking of impact is again takes on a very fundamental approach, and it's a framework that's built on the IMP principles and as well the GIIN definition as well of impact that specifically and concretely addresses the additionality component. And really, it's this additionality component that's the key anchor to a lot of the way that we think about impact. This is really where, for example, we're trying to build that strong and clear connection between investments and that real world impact. So looking at how the investments can actually help countries, for example, meet their development goals. So this can incorporate a lot of elements, and it isn't just directly the company's activities, and you need to take in a bit more of a context information as well. So let's take a company in the telecom sector, and let's take that company is the 5th mobile operator in Spain. This company will then hardly have the same contribution to the SDGs as a company offering access to low-fee mobile networks to underserved communities in Indonesia. Here, investors will need to consider the additional context, like the local country context, and looking at the country's progress to identify areas where there are substantial impact and growth opportunities. So for this, again, going back to companies, going very concretely into what is the impact that's actually being generated, and also is it contributing this to a market that previously didn't have access to those services and to those products, and how that actually helps the world close the gap. So for that, it's very hard to take a very systemic data collection view. It's much more fundamental. It's much more company by company, very detailed analysis and close interaction and engagement, really understand the work, the field, the market that they operate in, and to really, additionality, intentionality, and measurability, the measurability component being so important. So not just knowing that the company is doing something good, knowing exactly how many students have received access to education, how many individuals have now gained access to accessible and low-fee banking or internet access. So having this granular information is effectively one of the key requirements as well for our strategies to pass as impact. And this is why we don't refer to impact so broadly. We don't have that many impact strategies, because we believe that the impact strategies we have need to pass this very, very high threshold. So, so this is a very selective process and very engaged and very thorough, that takes on both public information, but also information from the companies, and really taking that really deep research of the company, but also the company's context to close that gap.
Thank you. Let's going to make the last question that has just come to the chat. Do you think SDG metrics and materiality assessment will remain proprietary by data provider or asset managers, or will we see some level of standardization, possibly fueled by regulation?
It's a good question. So I believe that right now a lot of the work is still being done on a more proprietary basis, because it's quite research intensive. But it does mean also then, of course, you don't have this universal language and assessment framework, which I think will be something that the industry as a whole would probably benefit from, and having this consistency. And kind of going back very briefly to what I mentioned, we've looked at so many different data providers, and they all have almost polar opposite approaches in some cases, or certainly very different approaches, both from a fundamental understanding, but also from level of granularity. It is a big challenge right now, the fact that there is so much dispersion in the way that it's being assessed. I think that would be a great outcome. It's really hard to tell, just because, again, we're still having such a big data gap issue, that I think if there was to be a very prescriptive instruction on how to do this, it will be so challenging to find the data to fill those gaps. Of course, I think that would be a fantastic direction of travel, but it's kind of hard to tell if that's where regulation is heading, or if it's still perhaps more regional, more regional country level prioritizations, with different countries ultimately making progress at different paces and at different goals. So yeah, it's a really fantastic question, and I think that'll be a good outcome, but I'm not sure if that's where things are headed anytime soon.
Thank you. Well, thank you very much, BlackRock, Anita and Claudia, for this event, and all of you for attending the this conversation and to discuss about sustainability. And we are going to leave it here. So thank you, and we will see you soon.
Thank you very much. Have a great night, everyone. Bye.
Thank you.
Bye.